So guys, this video is going to go over stop loss placement. We're going to talk about what validates a stop loss and what is truly a stop out rather than just a whipsaw. Stop loss placement. So guys, why is it important that you put your stop loss in the proper location? Well, a lot of times what the market will do, it will come back, it will have a pullback, and it'll hit your stop loss just to continue on in the direction that you thought it was going. It hits your stop loss because you have to ask yourself, why did you put the stop loss either so tight or so close to your take profit? Is it because you wanted to increase the amount of money you make on the trade? Could be. But you got to always remember, the stop loss should be placed for the same reason that you took the trade, right? So here's what I mean by you should place a stop loss for the same reasons that you took the trade. Now let's take a look at the chart that I have on the screen. This is the Euro USD. I'm using this pair as an example because it's what is probably the most commonly traded pair. We're looking at the 4-hour time frame. So as you guys may already know from my previous videos, if I'm looking at the 4-hour time frame and I have these session dividers on, like this dotted line to this dotted line, I'm actually looking at a week's worth of price movement, price action, or price data, however you want to say it. So here's the first example. Let's say I take a buy position right here. All of my confluences lined up, which means the moving averages would have been sloping upward. My oscillator could have been in an oversold, crossing back over to go and show me that momentum is moving to the upside. So hey, I decided to enter my trade right here. And let's say I place my stop loss right here at the swing low of this move, right? So essentially what I would be saying is this. I believe that this is the swing low for the week, and based on this swing low for the week, I believe price is going to go all the way up here, right? All right, so that's what I essentially be saying. I don't think price is going to come down and take me out right here, but I think price is going to continue to move to the upside. And as we can see, based on this particular move, that's exactly what happened, right? But that'll be essentially what I'm saying by placing my stop loss right here. But what if I'm wrong? What if price would have went down right here, I'm sorry, I should have used the other, hold on. What if price would have went down right here, created another move to the low, created another swing low, going into the next week, and then went ahead and skyrocketed up in the direction that I thought price was going, right? What if that would have happened? Would I technically be wrong in my analysis, or would I be wrong in my stop loss placement? Of course, I would have just been wrong in my stop loss placement, right? And I know, that's just what trading is a lot of the times. But you got to remember, guys, we're trading to make money, not to lose money, right? So all I'm saying is that the stop loss should be just as valid, or should be at a place where it invalidates that. Not only it shouldn't invalidate that this move is too low. The stop loss should validate the fact that you're in the wrong direction of the trade, not that the move is low. It should your stop loss being hit should tell you that I am in the wrong direction, not that price just wants to whipsaw or pull back a little bit more before it gives me the move. That's not why you should place a stop loss. Hear me out. I'm going to say this again, guys. Your stop loss should validate that you're in the wrong direction of the move, not that you placed a stop loss too close or too tight. All right. So here's what I mean. Here's what would be a better placement of this stop loss. All right. So if this shows the move of the current week on the 4-hour time frame, and you can adapt this to the 1-hour time frame, the session breaks or the session indicators on the 1-hour time frame will show the day of the move, right? If you were on the daily time frame, it would show the month of the move, so on and so forth. But since we're on the 4 hour, we're going to talk about it. And if I believe that on last week, price closed, the previous week, price closed right here. Price closed. So let's say price closed around here, right? And then for the week that I'm trading, price came up, came down, went up. So this actually wouldn't have been the low for the week. This would have been the low for the week, but this is the pullback for the week, right? Price came up, came down, and it shot out of there, right? But wouldn't it make more sense if the stop loss was back here at the low of the previous week than at the low? Here's why I say that. Because if price started at this low, right? And price moved up, right? Closed the week down here, then came up again, gave you a pullback. Well, until price drops below the low of the previous week, then wouldn't you say price is still in an uptrend? Until price drops below the low of where it started the previous week, wouldn't you say price is still in an uptrend and move? Because if the previous week started at this low, price went up, pulled back a little bit, and went up again. The only thing that would invalidate that you are in the wrong direction, meaning the only thing that would invalidate that you are in the wrong, that you are trading, that your buy trade is not a good trade, is if price dropped below the low where it started right here. If price dropped below this low, then that would tell you that this move to the upside is invalid. Price no longer wants to go higher. Price wants to go lower. That's what it would tell you. The reason why this isn't a good stop loss at this level, because price could drop lower. Price can drop lower, create another low, and then take off to the upside. But until price drops lower than where it started, then this is all still an up move. This is all still an up move, just with a little pullback going on. But if price drops below these lows right here, then you automatically know, hey, I am on the wrong side of this trade. Price is trading lower than where it started. When I validated why I wanted to go long, right? Price is now beginning to trade lower. So that would really invalidate my analysis of the trade. If I think price is going higher, the only thing that would tell me that I am wrong is if price trades lower. So your stop should go right back here. That is a valid stop. The price could do all of this funny business in here. It could pull back. It can pull back to here, here. As long as it doesn't violate this low right here, you're still in an up move based on where you started, based on where you started your analysis from. And of course, if you're buying off this pullback, then your analysis won't start on the pullback. You're going to start saying price move up, it's pulling back, boom, it's going higher, right? Looks like it wants to go higher. So your analysis would start back here as to where the reasons as to why you feel price is going to go higher, right? Let's look at another example, guys. So let's find a sell trade. Let's look at another. Let's look at the pound. Well, the pound is correlating, so it'll be going the same direction. Let's look at the USD JPY. Okay, this is on the 4 hour, right? So let's find a location where price is going down. Okay, with this word, alrighty. So this is a prime example of what I'm saying. So price drops here, right? It gives you a pullback here. So let's say you took the trade right here. You say, I'm going short. You automatically see, if you put your stop behind this swing high, it took you out right here. It took you out. But doesn't mean that you were wrong in your analysis. I believe price is going to trade lower. So price did start to trade lower, right? Price traded lower, but it would have took you out prematurely, because although you weren't wrong in your analysis of where price wants to go, You were just wrong in your stop loss placement. So why would you place a stop loss here? Simply because it's the swing low. I mean the swing high. Just simply because it's the swing high of this move, you place your stop loss here. Not a good idea. Because what tells you, what validates to you that your stop loss is in the wrong location? If your stop loss pulled back here, if the price pulled back here, and then it started to trade down, does that mean you're in the wrong direction of the market? No, it doesn't. It just means your stop loss is too close. I would have put my stop loss here, and here's why. Price can pull back all it wants up in this area right here. Price can pull back, but it's still lower than where we started. So if price pulled back here, yeah, price is moving up, but based on where I started my trade, price is still in a downtrend. It pulled back. It had a deep pullback. Yeah, it did. If price would have pulled back to here, but it hasn't violated where we started. What I'm saying is the reason why I've taken this trade to the downside is because price started here, it came down, it retraced here, and now price is turning over, and it looks like it wants to continue down. That is the reason for me taking the trade. So the only thing that would invalidate my reason for me taking the trade if price broke this level right here where price started. If it never breaks this level where price actually starts, then my trade is still good. Yeah, I may be in some drawdown, some negative equity, but I haven't lost the trade until price. I hope that makes sense, guys. All right. So what I want to talk about is, well, why don't people? Simply because the stop loss is wider, right? So if your stop loss is here, right, and you're into the trade here, you can get to your take profits. You can make more money on your trades if you tighten up your stop loss a little bit more because you're taking less risk, right? But here's the flaw with that. If you're only trading a certain percentage of your account per trade, like me, I only trade 2% of my account, then 2% is the same amount of money if I'm risking 80 pips here or if I'm risking whatever this is, let's say roughly 300 pips. 2% is 2%. Yeah, it may take me longer to get to 300 pips, but still, 2% is 2%. 2% is 2%. So the reason why people don't like to put their stop losses so far away is simply because they feel they can make more money. But I guarantee you're going to give away a lot of trades also by getting stopped out prematurely. Not because you're wrong in your analysis, but because that's how the market is. The market whipsaws. The market makers, they know if I have a lot of stop losses, okay, if I have a lot of stops back here, people going low, of course they're going to bring the market up and stop you out. It's not by coincidence that the market came right here, right past the stops. This is for you. This is for those that choose to put their stops back a little more. And this is for those that chose to put their stops back a little more. The market came and got all of y'all. Right? But one thing the market won't do, it takes too much money for the market to pull back all the way back up here. It's going to take the market way too much money to pull back all the way up here. They're not coming back here. If you're in the right, if your analysis is correct and price is going to continue to fall, they're not coming back here, not coming way back here, because people aren't going to really put their stops behind the swing high or swing low of the previous week if you're trading a 4-hour time frame. Okay? Let's see. This is a 15-minute video as of right now. So we're going to end it. But just remember, guys, if you go down to the 1-hour time frame, then it's the same concept. You're just looking at it from the 1-hour time frame perspective, like this trade right here. If you buy here, then essentially what you're telling the market is price is not going to pull back any further than this. If you put your stop loss here, price isn't going to pull back any further than this, and I'm good to go. The price is going to shoot up. Well, we all know that's not how price works a lot of the time. Price will come back and double bottom out, retest levels, everything, right? So your analysis for going long, that's where your stop loss should be. Why are you going long? Because you feel as if price will not go past the swing low Here's where you started your analysis. Boom, pull back, boom, boom. So price. So this may be a good place for your stop loss, but I will make it practice to put my stop loss behind the swing low or swing high of the previous day, week, or month, depending on what I'm trading, right? And making money in trading, guys, it's not something that happens overnight. It's a slow process. So if you're trading, trust me, taking from someone that's been trading now for over 6 years, you shouldn't try and get rich overnight. Simply meaning that you shouldn't try and make, over leverage your account, risk more money than you should be risking on any one particular trade. That's the recipe for disaster. It won't work. It only worked probably for maybe 1-2% of the people that ever traded, especially the Forex market. Don't believe the day trading gurus. I'm not here to down talk. I just don't believe it. But learn how to trade. Learn and understand the markets. Understand stop loss placement. It is just as important as the reasons as to why you entered the trade. All right, guys. If you learned anything from this video, please like, share, and subscribe to my YouTube page, Forex King. I'm out.